Welcome to the Al-Attiyah Foundation's second in a series of podcasts where we seek to address the urgent energy topics of today by hearing the opinions and insights of experts. The Al-Attiyah Foundation is an independent think tank aiming to provide robust and practical knowledge and insights on global energy and sustainable development topics and communicate these for the benefit of the Foundation's members and community. During March and April, we've seen some unprecedented activity in the fossil fuel markets. So we're seeking some explanations on what's causing this volatility and some insights into what the future may bring. Today, I'm delighted to welcome our second podcast guest, Professor Paul Stevens. Paul is a distinguished fellow at Chatham House, having first joined the Institute in 2008. He was educated as an economist and specialist on the Middle East at Cambridge and the School of Oriental and African Studies. Between 1993 and 2007, he was Professor of Petroleum Policy and Economics at the Centre for Energy, Petroleum and Mineral Law and Policy at the University of Dundee. He is now Professor Emeritus at the University of Dundee. He's also a distinguished fellow at the Institute of Energy Economics Japan in Tokyo. In March 2009, he was presented with the OPEC Award in recognition of his outstanding work in the field of oil and energy research. Good afternoon, Paul. Welcome once again to an Al-Attiyah Foundation activity. You've participated in a few events in the past. It's great to hear from you again here on this podcast.
It's a pleasure to be here, and I'm looking forward to what will be an interesting, if rather uncertain, 20 minutes, given the state of the market.
Well, the uncertainty perhaps will just only make it more interesting. So let's get straight into it then. Well, the catchphrase of the day seems to be demand destruction, and demand destruction on a very unprecedented scale. But should we have anticipated perhaps lower prices anyway with the overproduction in both crude oil and gas markets?
Let me just pick up on your term demand destruction, because I think this is an extremely important point. There is demand destruction and there is what I call demand deferment. Let me briefly explain the difference between the two. The demand for oil is a derived demand. Nobody wants a barrel of gasoline or a barrel of fuel oil. What they want are the energy services provided by that fuel. They want light, heat, and work. To get those services, they need energy-using appliances. And this gives rise to a three-stage decision which determines the level of demand. The first stage is to ask the question, are you going to buy the appliance? The second question is, if you're going to buy the appliance, what type of appliance are you going to buy? Are you going to buy an efficient or an inefficient one? And then the third question is, once you've bought the appliance, what capacity utilization are you going to use? In other words, how many miles will you drive? Now, the logic behind this is that once you've made those first two decisions, then the appliance stock is fixed in the short term. And what that means is that if you're going to use the appliance stock or not use it, it's the third decision which matters. Now, if you change the appliance stock, that is demand destruction. So if you switch your petrol car to an EV or your oil boiler to a gas boiler, then that is demand destruction. That demand will not come back. But what we've seen since the start of the year is people simply reducing the capacity utilization of the existing stock. In other words, it's not destroying the demand, it's simply deferring it. Now, what that means in practical terms is that when the pandemic is over and the economic activity begins to recover, then oil demand is going to go back up again.
Will it all come back up, Professor? There are those who are saying some of it may be transferred into other sources of energy, or is that a little bit of too much green thinking, shall we say?
I think this is absolutely spot on. And the point being is that although the appliance stock has not changed, the behavior of the consumers are quite likely to change. So the big question, and we don't know the answer to this, is will oil demand come back to the sort of levels we saw before the pandemic? And this is the key uncertainty. And we simply don't know until it happens whether that is going to be the case. But the idea of demand destruction is that the demand won't come back. Now, what sort of change of behavior are we talking about? Well, let me take an obvious one, which is flying, air transport. Are we likely to go back to the old days when you had planes full of people with all of the restrictions that apply? Now, when we have a vaccine, that is quite likely to be the case. But until we get a vaccine, you're not going to see the recovery in air transport that will lead to an increase in demand for jet fuel. Now, could all of this have been predicted? And I think the short answer is yes, except for one thing. The problem started with oversupply of crude oil in the market, and this began to put a downward pressure on price. Saudi Arabia was trying to control the situation, and as in the past, it was trying to get support from some OPEC members and some non-OPEC members. The problem with this is that the non-OPEC members and indeed some OPEC members were simply cheating. And that was all perfectly predictable. And you could see that the oil price would fall. You could also see the potential for a price war between Saudi Arabia and Russia. But what you couldn't see was the collapse in oil demand as a result of the pandemic. I mean, the numbers vary enormously. It depends who you listen to. But if you think in terms of oil demand before the pandemic at around 100, a sort of the 100 mark, then after the pandemic started, demand has reduced by 30 to 40% in a very, very short space of time. And it was that collapse in demand, which, to be fair, was not foreseeable, which has led to the dramatic collapse in price, not just the collapse in price, but the fact that at one point, WTI was selling for minus $37 a barrel. In other words, you have to pay somebody $37 a barrel to take it away. This is absolutely unheard of.
Right. So we're looking at a lot of demand deferment and to some extent some demand destruction. We just don't know to what degree yet. What about the role that oil producers can play to alleviate this? You know, I'm talking about OPEC, OPEC plus, the G20. We've had a deal, haven't we, to cut production. What do you think that might do for the supply position? Is it too little, too late?
Well, I think there certainly is too little, too late in that bit of the story. And of course, this is what led to the price war effectively between Saudi Arabia and Russia, when effectively Saudi Arabia tried to get a deal with Russia, and the Russians wouldn't accept it, and the Saudis walked away, and effectively that started the price war. The problem now is that the OPEC Plus agreement, so-called, has been revived. Simply because faced with negative oil prices, the big players, Saudi Arabia and Russia, had very little choice in this matter. But the problem there is that although they have cut production, the oversupply because of the fall in demand is still dramatically very high. And indeed, as we speak, oil storage is filling up all around the world. And indeed, a lot of people are using large tankers as storage. So there is a danger there that we could move back into negative oil prices as we go forward.
When?
My second law of forecasting is to give them a number or a date, but never give both at the same time.
We want to try and force you to look into that crystal ball, which I know you've got on your desk.
My view is that the oversupply is going to continue for a lot longer than many people think. A lot of people are talking about a sort of V-shape recovery for oil demand. I just don't see that happening. The oversupply is so large, it's going to take well into next year before the supply overhang disappears. And while that supply overhang is present, then there's going to be a downward pressure on prices, continued downward pressure on prices.
Well, that's a real that's a very scary forecast, isn't it? Where does that leave shale oil producers in the US? Where does it leave the tar sands in Canada? Are they doomed?
I think if we're talking about the US shale story, then it's going to have a very negative effect on them. A lot of companies are going bust, have already gone bust, and the rig count in the United States has fallen dramatically. The important point to make here, however, is that although shale production falls dramatically, it can increase dramatically as well. There's a very short lead time on a lot of these projects. But nonetheless, certainly US demand will, US oil supply will diminish. Canada is a different story because the problem with Canadian tar sands is that it's more like a manufacturing process. It's not something you can stop and start. So once you've got the process up and running, if you close it down, it's very difficult to get that oil flowing again. And this is true, by the way, of a lot of other oil fields as well. It's not easy to close them down because you get into problems of corrosion in the system and other bits and pieces as well. Some fields you can stop and start, but not all have that capability.
Mm-hmm. Let's talk a little bit about gas then. Will contract gas prices be dragged downwards too because of the low crude oil prices?
That very much depends on the nature of the contract. What we've seen in the last few years is a movement away from linking gas prices to oil prices. The reason for that link, by the way, goes back into history. And the problem was that if you don't have a gas price and you want to sell gas, you have to come up with a price. And so the original idea, which came out of Holland, was that you price the gas against the fuel it's replacing, which at the time this was happening was basically oil in power generation. And so you have that contractual link. Now, in the last couple of years, we've seen pressure to remove that. So in Europe, for example, there are virtually no contracts now gas contracts based upon oil prices. In Asia, the same is true, but there are still some links there. Now, part of the problem is that the gas market itself is in a bit of a mess because there's significant oversupply, particularly oversupply of LNG. And this is as a result of the gas market is peculiar because the supply side has very long lead times on projects. And so you see this sort of surge of capacity coming on stream based upon decisions that were made 5 or 6 years ago. The other problem as well is that electricity demand has fallen generally. And of course, gas has a major role in generating electricity. So there is a direct competition between gas and renewables. And so as the demand for electricity falls, the demand for gas is also likely to fall because renewables, in many cases, are now a more attractive option.
All right. We can't talk about the Middle East and North Africa without talking about the political landscape, though, of course. We do read from time to time about the problems oil producing countries are going to have in balancing their fiscal budgets because of the low oil prices. Does this mean difficult times ahead for all those oil producing countries who are rentier economies, Professor?
Very much so. What is coming home to roost now is the fact that the oil producing economies of the Middle East should have started diversification seriously at the time of the first oil shock in 1973. And there's been a great deal of talk about the need for diversification, but very little realistic action has taken place. And so many of the oil producers in the region are facing serious fiscal problems. But it's more complicated than that because the whole basis of the rentier society in the Middle East is we will give you subsidies and jobs, and you let us do what we want to do politically. Now, in a way, that began to break down with the Arab uprisings, the Arab Spring, whatever you want to call it, in Tunisia in 2011. In this fiscal system, that social contract, we will pay you to be quiet, is no longer going to be very effective. And the producer governments are going to face serious difficulties. Just look at Saudi Arabia in the last 2 days. It has trebled the VAT rate from 5 to 15%, and it has dropped the income allowance that was introduced when VAT was introduced to try and offset the impact of higher prices. Now, that sort of behavior by the governments is not going to go down well with the population. There's also the problem that something like a huge proportion of the population in the region is under 30. And the one thing they really want are jobs. And one of the consequences of what's happening is that jobs are going to be even scarcer than they were before. And this is likely to therefore lead to all sorts of problems. You're going to be seeing failed states. You're going to be seeing domestic unrest. Sorry to sound so pessimistic, but I think this is the reality of it, and it needs to be faced up.
Well, let's talk a little bit about the future. After the pandemic is over, hopefully, will it be business as usual? I think the world economy will bounce right back. I know you touched a little bit on this when we were talking about demand destruction versus deferment, but ultimately, do you see demand and prices ever going back to where they were?
I think the short answer to that is no, because before the pandemic kicked off, the whole world was going through an energy transition, a move away from hydrocarbon molecules to electrons. Now, many people, including myself, believe that the conventional energy establishment, the IEA, OPEC Secretariat, were seriously underestimating the speed and depth of that transition. Now, an interesting question, here's another uncertainty to think about, is will the pandemic and its impact speed up that transition or slow it down? And there are schools of thought on both sides of that occasion. I am of the opinion that it's more likely to speed up the transition. And so what that means is that peak demand for oil, and we're talking here about the sort of demand peak rather than the supply peak, is more likely to happen before the end of this decade. And thereafter, it's going to be declining. Now, what that means, of course, is that the existing oil producers are going to be competing for a declining market. And so whatever happens to the volumes, the pressure is going to be downwards on prices. So we're never going to go back unless something traumatic happens in the Middle East, like some major shooting war takes place, which is not impossible given the present state of relations between Iran and the United States. But absent that, you're never going to see the sorts of oil prices that we saw 4 or 5 years ago. In other words, over $70 a barrel.
There are a lot of opinions, as you said, on whether this crisis is going to speed up or slow down the transition. Explain your reasoning for why you believe it's going to speed up the transition to renewables. Is it because, as some people claim, the renewables are demonstrating the advantage of low upkeep costs in insulating themselves from market volatility?
That's certainly part of the story. But the other point about renewables is that they are domestic. And one of the consequences of the pandemic, in my opinion, will be that countries will be looking far more strongly at becoming self-sufficient in all sorts of things, including energy. And for that reason, the beauty of renewables is that they can be domestically produced. You're not dependent upon somebody else supplying through the Straits of Hormuz or the Bab el-Mandeb or whatever. And so this will drive a greater use of renewables. And of course, the other point as well is that the cost of renewables has been coming down dramatically. Now, you may say, well, yes, okay, but the cost of oil has been coming down as well. But I would make 2 points there. First of all, a lot of the oil companies are reluctant to pass on the lower cost of crude to consumers because they're struggling with their own finances. And so that is not certain. And the other point is that a lot of governments are going to be desperate for revenue because the cost of stimulus packages to try and offset the effect of the pandemic mean that they're going to be looking for revenue. A great source of revenue is to impose sales taxes on oil products. And so any reduction in the cost of crude oil is likely to be offset by increased sales taxes put on by governments.
Interesting. So now that we're deeply looking into your crystal ball, when do you think the peak year is?
For oil demand, I think it's going to happen before 2030, in the next 10 years, in other words. Now, in a way, that's the least interesting question. The more interesting question is when you reach the peak, what happens next? Is it going to be a slow, gentle, declining plateau, or is it going to fall off a cliff? And my best guess is it's more likely to be the cliff scenario than the gently declining plateau. And if I'm right on this, then the implications for the oil producers of the Middle East are going to be extremely serious.
If that's the case, are we already seeing some of that thinking impacting investments into the energy industry, particularly renewables?
Absolutely. I mentioned earlier that the energy establishments are underestimating the speed of the transition. The financial community, however, seem to be far more savvy than the energy community, and they have already foreseen the issue of stranded assets, reluctance to invest in fossil fuel supply, and this sort of behavior. So the financial community, I think, is ahead of the game compared to the energy community. The energy community, of course, has a problem. It has a lot of strong vested interests. If you're a big oil company, it's difficult writing to your shareholders and saying, "Dear shareholders, it's been nice knowing you, but the good days have gone." I mean, that is going to be disastrous for those companies.
I always like to end on a positive note, but that is at least a very serious note for consideration. It's been great talking to you, Paul. Thanks for your insights and your time today. We do indeed live in interesting times. I think we can both agree on that.
We do, and I'm sorry if I've been very gloomy, but I'm afraid it's the way I see the future.
Thank you very much. We'll watch this space for the next podcast in the series. As a non-profit independent organization, the Foundation would also like to thank its members. Their continued support is valued and appreciated.